Have you ever heard of dollar devaluation? It's a term that's been in the news lately, and you might be wondering what it means. Well, let's dive into it. The value of the US dollar is determined by various factors, including the supply and demand for the currency. When the value of the dollar decreases compared to other currencies or goods and services, it's called dollar devaluation. One reason for dollar devaluation is an increase in the supply of dollars in the market. When there are more dollars in circulation, each dollar is worth less because there's more of them available. The Federal Reserve can increase the money supply by printing more money. When they do this, there's more money in circulation, and each dollar is worth less. A decrease in demand for US dollars can also lead to dollar devaluation. When investors and traders lose confidence in the US economy or political stability, they may sell off their US dollar assets and shift their investments to other currencies or assets. This can lead to a decrease in demand for US dollars and cause the value of the US dollar to decrease. For example, if investors believe that the US economy is going to experience a recession, they may choose to sell off their US dollar assets and invest in other currencies or assets that they believe will be more stable during a recession. This decrease in demand for US dollars can cause the value of the US dollar to decrease. Another example of a decrease in demand for US dollars is when other countries decide to use a different currency for international trade. For instance, if countries decide to use the euro or the yuan instead of the US dollar for international trade, the demand for US dollars will decrease, causing the value of the US dollar to decrease. Overall, a decrease in demand for US dollars can lead to dollar devaluation, which can have both positive and negative effects on the economy. The effects of dollar devaluation can be both positive and negative. On the one hand, it can make US goods and services more affordable for foreign buyers, boosting exports and stimulating economic growth. Dollar devaluation can have positive effects on the US economy by making US goods and services more affordable for foreign buyers. This, in turn, can increase demand for US exports and help boost economic growth. For example, let's say that the US dollar is devalued compared to the euro. If a US company sells a product for $100 USD and the exchange rate is $1 USD to 1 euro, then the price of the product for a buyer in the Eurozone would be 100 euros. However, if the US dollar is devalued and the exchange rate becomes $1 USD to 0.5 euros, then the price of the same product for a buyer in the Eurozone would now be 50 euros. This means that the product has become cheaper for buyers in the Eurozone, making it more affordable and potentially increasing demand for US exports. This increase in demand for US exports can lead to job growth and increased economic activity in the US, which can have positive effects on the overall economy. So, while dollar devaluation can have negative effects, such as inflation and increased costs for imported goods, it can also have positive effects on the economy by boosting exports and stimulating economic growth. On the other hand, it can make imported goods and services more expensive for US consumers, leading to inflation and higher prices. When the value of the US dollar decreases due to devaluation, it means that it takes more dollars to buy the same amount of goods and services from other countries. This, in turn, makes imported goods and services more expensive for US consumers because they need to spend more dollars to purchase the same amount of goods or services. For example, let's say that a US company wants to import 100 units of a product from a foreign country. If the exchange rate between the US dollar and the foreign currency is $1 USD to 1 unit of foreign currency, then the cost to import those 100 units would be 100 units of foreign currency or $100 USD. However, if the exchange rate changes due to dollar devaluation and becomes $1 USD to 0.5 units of foreign currency, then the cost to import those same 100 units would now be 200 units of foreign currency or $200 USD. This means that the US company would have to pay twice as much for the same amount of goods, making imported goods and services more expensive for US consumers. This increase in cost can lead to higher prices for imported goods, such as cars, electronics, and clothing. This, in turn, can lead to inflation, which is a general increase in the prices of goods and services over time. In summary, dollar devaluation is when the value of the US dollar decreases relative to other currencies or goods and services. This can happen due to an increase in the money supply or a decrease in demand for US dollars. The effects of dollar devaluation can be both positive and negative, affecting both exports and inflation. Thank you for watching. Be sure to subscribe to our channel for more informative videos. There are several ways that individuals and businesses can take advantage of dollar devaluation. Here are a few examples. 1. Invest in foreign assets. When the value of the US dollar decreases, foreign assets become relatively cheaper. 1. Investors can take advantage of this by investing in foreign assets such as stocks, bonds, and real estate. 1. This can provide diversification and potentially higher returns than US assets. 2. Increase exports. As mentioned earlier, dollar devaluation can make US exports more affordable for foreign buyers. 2. This can create opportunities for businesses to increase their exports and expand their customer base. 3. Attract foreign tourists. When the US dollar is devalued, traveling to the US becomes more affordable for foreign tourists. 3. This can create opportunities for businesses in the tourism industry to attract more foreign visitors. 4. Hedge against inflation. When the value of the US dollar decreases, it can lead to inflation in the US. Investors can protect their assets against inflation by investing in assets that tend to perform well during inflationary periods, such as commodities like gold, silver, and oil. 5. Refinance debt. When the value of the US dollar decreases, it can lead to lower interest rates. 5. This can create opportunities for individuals and businesses to refinance their debt at lower rates, potentially saving them money on interest payments. It's important to note that taking advantage of dollar devaluation involves risks and uncertainties, and individuals and businesses should consult with financial advisors before making any investment decisions.